Welcome, everyone. I'm Dr. Fasanya, CEO of Dr. BDZ Capital, and we have my co-host, Dr. Ozoude, is the CEO for Camel Capital. So together, we bring this webinar every 2 weeks, and hopefully soon every week, where we try to educate our investors and also bring other guests to this webinar to educate us. Most of the time, we also learn a lot from this because we brought people with car wash deals. We had people with different type of asset classes that we even don't, do ourselves. But today, we are switching things up a little bit. We used to do this on Saturday, like George said, at 4 p.m. Central, and it cut into people's family time, and we just trying it out on the Wednesday, 6 p.m. It's going to be end of the day, the weekdays, where you're still in that mood of getting things done. We're going to be talking mostly about some success stories and also the lessons we've learned from syndications in the past. George is going to be taking the reign on that one. He's going to be talking about one deals that he had thought was a goner. But then ended up being a good return, and it was made whole at the end. That we feel like those kind of story is necessary because sometimes you have a deal, and in your first year of the deal, you already make up your mind that, man, this is bad because you don't get the distribution. So I'm going to let George get started.
Yeah, I got so many deals to share. I may not even get to all of them, but I definitely want to talk about kind of success stories and then challenging stories. So I'll probably run the gamut. I'm going to start with probably the best real estate syndication multifamily deal that I did. And this is my third deal overall. And just for context, I've been investing in syndication since 2017, and I've been invested in about 25 of these deals total across multiple different asset classes. My third deal in multifamily was in 2019, so keep some of these dates in mind. Early 2019, about March, I made an investment into about a 210 unit multifamily deal in San Antonio with a syndication group. And it was a very good deal overall. The total purchase price was about 7 mil, and then we ended up selling for about 14 to 15 mil. We sold in October of 2023, so literally last October. So we held the deal for 4.5 years. This was actually one of the only deals that I've experienced what's called a cash out refinance. The deal was purchased at a very good price where we had a good amount of equity in the deal. We had fixed rate debt, and we were able to raise the rents by adding value. And by September of 2021, we were able to get a cash out refinance. They gave us back 83% of our initial capital. And so I gave them a minimum investment. That's how I always start out investing. Gave them $50K. They gave back 83%. Up until that point, they had been making distributions to the rate, the cash on cash return, to the rate of 11%. So they're making 11% cash on cash all the way to a refinance event about 2.5 years later after initial capital was deployed, 83%. So literally I've gotten back my entire initial capital, partly some of it in cash flow, partly in a chunk of it in that refinance event. Then we still continued to cash flow even after that until the sale about 2 years later. And so the total returns for that deal ended up being 36% average annualized return and a 2.6 equity multiple. This was like one of my first experiences, and I thought, this is great. So that gave me high hopes, and that's probably why I invested in 22 more deals after that. Great return numbers, great communication. So much, I loved the experience so much, I invested it again with the same operator once she made the cash out refinance and had another deal. This deal, the second deal, was in late 2021, so November. Oh, sorry, which market? That was San Antonio. And that was a multifamily, large multifamily, value add. So it was like a 1970 build. So next property, same operator, a 1970 build, this time in Fort Worth, Texas. This time it's late 2021, so things have started to change, right? There's clear indication by the Federal Reserve that they're going to raise rates. That happened in November 2021. That's when the inflation was cooking. And that's when things really turned. That's why 2022 and 2023 was such a headwind year. So that deal in Fort Worth, 10.3 mil purchase price. And right now it's struggled so much that we've not gotten any cash flow, no cash on cash return since then. So it's been what, a little over 2 years. And now we're faced with selling the property at a devalued mark. 8.5 mil is what we're looking to sell. They just sent the email last week. And so what we're told as investors is that we're going to lose about 60 to 65% of the original capital at this sale price. And so this was like obviously devastating. But I don't mind learning the lesson. I want to learn the lesson. Obviously, I don't like losing capital, but I'm going to use this opportunity to learn as much as I can. And so I went back and tried to look at what went wrong. When I even asked the operator, who I've obviously get to know, what she could have done differently. And I want to share some of those things because I think that's helpful. Lessons learned. So she mentioned that the value of the interest rate protection was huge. We needed to purchase something called a rate cap. And so getting enough of a rate cap, especially when the interest rates are going up, is super important. The amount of leverage, the target leverage that she would have preferred is 70 to 75%. That means she was probably over leveraged with the bridge debt. And that's what they used for this purchase. It was a bridge debt, variable rate loan. The loan was at 4% to start, and then it was variable rate after that. That went through the roof, went almost to 10. This is not sustainable. She mentioned having a high CapEx contingency because it was an older asset, because we faced a lot of repairs. So I was depleting the reserves. She also mentioned over raising more so you can have reserves in the bank so that you can weather some tough storms, tougher times. And so literally I'm expecting to get 33% back of what I originally invested. No cash on cash return, no equity multiple. The equity multiple is negative. So devastating, but lessons learned. Invested 60K, who knows what I'm going to get back, probably 20K. But I'm going to use that 40K as tuition. So now my takeaway is, when I made that first investment in 2019, I probably didn't look as closely at the debt structure in reference and respect to the market cycle. And now I'm looking at that debt structure. I'm very focused on it. I want to know who's in the capital stack. Is there a senior lender usually? Is it agency? Is it a private lender? Is it a construction bridge loan? Is there mezzanine debt in between? Is there pref equity on top of that? And then is there common equity, right? Who's the end of the capital stack? I look at that now, and that makes a huge difference. Before I only just looked at underwriting, but I think before I just looked at some assumptions in the underwriting, not necessarily the debt structure. But I like to bring this one up because it's the same operator. And in 2019, everything's rosy, right? Market going up. 2021, not to belittle or anything about this, she's great, and I'd probably invest with her again because I think she learned a lesson too. But market cycles matter. Investor or operator experience and track record matter. Someone who's probably gone through 2001 and 2008. I think those operators were very much so pens down, pencils down. They weren't doing deals over the last few years because either it was too expensive, they knew the properties were valued too high, or they were only able to compete for those investments with variable rate loans. Almost no one was doing fixed rate loans in 2021. And so this is huge. If you're a seasoned operator and up, only variable rate loans are out there, time to probably back away from the market. So that's two. I'm going to pause there, let Bio jump in because he's got That's LP experience. Bayo's got some operating experience. We'll go back and forth and let him share some of his stories. Any
Yeah.
questions about that before we go to Bayo?
Someone said something about communication. One said, was the operator transparent throughout the whole?
Completely transparent. This operator, she has the best investor updates, so much so that now that I'm doing co-GP work, I've shared it with my colleagues who I'm on their sponsor team. Look at this framework of how they communicate investor updates and keep people updated on the capex and the vacancy and where things are going and how much reserves are left. And through that turbulent deal, she was very open and communicative. And that's why I said, look, yeah, she struggled, but based on how she communicated, I probably would invest with her again. She was been transparent the whole time, even polling, getting votes to see what the temperature of her investor base is. Obviously, they have to make the final call, but she was very considerate. Totally a 10 out of 10 for communication.
Dr. George, I wanted to go through your list of lessons you learned again. So I have here, try and overraise money for reserve. I have be careful of bridge loans. I have go for fixed loans if possible. Be completely transparent to your investors. What other lessons do you have written down?
Yes. So leverage, you want to stay in a very happy range here. You don't want to be under leveraged or over leveraged. And I think to win a lot of deals, there were a lot of operators who were over leveraging, 80, 90% leverage. So not enough equity in the deal. Purchasing long enough or big enough interest rate caps. And those got very expensive. So that may make you go pencils down if you see these interest rate caps are getting too expensive. But that probably protected a lot of people if they purchased enough of an interest rate cap. And those who purchased maybe 1 year or even less interest rate caps, they got in trouble real fast, you know? Yeah, those are, I would add those to the list as well.
Yeah, I like to hear both sides of the story. So great ones, George. I know you told me those, but I like it with everyone. And as an operator, it's very it's a very tough job. And sometimes I rethink it sometimes because I'm like, man, because people don't know what's happening on the net, everything. However, with great communication, I second that. Let people know what's happening. In terms of over raising, I learned that from my mentor, Guarav. Guarav is one person that always he doesn't go for that when you're doing the underwriting. All of them always have that minimum. You should do that, but usually raise a lot more. Even if I need 20% down, oftentimes almost always raise about 30%. So that's because that could help you weather the storm. It's going to decrease the overall return. That's why many people don't do it, right? If you raise more, then when you do your underwriting, it's going to show, maybe 1.9x, right? Instead of 2 point something. But the thing is, most of the time, you will end up putting those money back. And usually you distribute it again at the end. So, so oftentimes the return will be slightly higher, even if you overraise. That's just my own experience on that front. Deep value add, I can add more, on the deep value add part. I've had a recent experience, and I know we're talking about syndication, but, just going to talk about, because we also have a deep value add, real deep value add that we're doing right now. And it's I'm not saying it's not like the most risky. I still think private development is riskier. However, if you're going walk down to the stud, there's so many variables. And, I bought one, which is with 3 people. So this is actually fell along joint venture, a very smaller deal. And I've done multiple of these. If you want, you can look into on the YouTube. I can find one that Josh talked about a few months ago, which the return within a year and a half was over like 30% or even close to 40%. Very great return. Because almost like a flip. We do that sometimes. You buy, you fix it up, and you sell it very quickly. So I thought so for this deal. So it was a smaller deal too. It was a 9 units with a laundry. So it has a laundry room. My plan was to convert also that laundry room into another 2-bedroom, 1-bath, 10 units total. And bought it. It was $250,000. And it was literally condemned. This is the level of deep value add. It was literally, there was like the inspector was about to condemn it, the city. And I was like, oh, you know what? I got a team and they've been working with me for a while. Let's take this on. And we did it. So first thing was there was a lot of delay, right? And delay steals so much of your profit in a way, because you have to continue to pay insurance, you continue to pay bills while no rent coming in. So that's the number one part. The number two was, of course, the contractor. When picking contractors, my own other lesson is pick someone, even might be slightly more expensive, but someone that can get the job done. Far more important than trying to save money. So I got quotes, right? I got quotes to fix it. It was 200. One quote was like ridiculously low, like 150,000. Then I got 200. Then I got a $350,000 quote. Then in my mind, I was like, I'm gonna go for the middle ground guy. And also, this person was like a kind of a family friend, which is another thing you should learn. To go for the most competent, no matter what, even if it's me, somebody else, and you're like my best friend, and you go with the most competent, I will understand. So I was like, oh, I can do it. He's done some few units, maybe 1 or 2 units for me before. And I thought scaling to 10 units, yeah, I can do it. So anyways, more of the story is, yes, it was delayed by at least 6 months. And also we end up spending actually close to that 350 from the 200, because most of it is, some of it's not his fault, because there'll be mold, and then by the time you knock that down, there'll be more mold. But the thing is that you underestimated, in my opinion. So those are it. So I also wrote down some few lessons. So let me just other lessons. Eventually, everything worked out well because we did appraisal. I finally appraised it for $670,000. But it could have been so nice, right, if I have gotten away with it with much less cost. So one thing, importance of reliable contractor, right? A reliable contractor is the backbone of your project. Don't learn the hard way. So make sure you have better contractors. And when we're doing like a bigger multifamily or syndication, obviously we find contractors that are very experienced. They've been working with larger units. In fact, if you tell me you've done 10 units, I'm not going to trust you with 129 units. It's just different. But people will try to tell you that they can do it. Also, be right contingency for delays. Okay. So when I wrote my underwriting, I think I've written for like maybe 3 months or 4 months delay, right? Because I'm like, I'm sure we can get this whole thing done in maybe 9 months. So you might want to double it, because we didn't only have that in this one. We have a luxury senior living. One of them is finished, the other one is still delayed. So that's something to think about. Also, balancing budget and quality. This is a very hard one for many people, okay? So if you're doing a Class C property, you need to only renovate it to Class C level, nothing more. Don't let anyone talk you into trying to make it nicer. Oh yeah, we're gonna you can do laminate, LVP for the floors. Keep it simple. But many people, that's what I found out to be the most common issues, at least we've had in the past, when someone tried to renovate more than what is needed. And also the quality too. Look for something that lasts longer rather than something that looks cool. So those are the things. And of course, communications. So because there was communication between stakeholders and everyone, so it wasn't too bad, right? And also when people do joint venture, they're usually more forgiving because there's not a lot of people in the deal, right? There's like maybe 5 of you, and everybody was local. So you can all meet over there and talk about it. So yeah, I'm going to piggyback. If you have any more questions. We still have the asset. We rented it out, and we're still waiting for opportunity to sell.
I think these are great points because even if you are doing it on your own, these are good points even if you wanted to syndicate, right? It's still applicable because you may find yourself leading syndication if that's in your goals, in your objective. These are still fundamental things that I think you can take and you want to see your operators doing if you're going to be an LP. So, love it. Any questions about that one? Okay, so I shared.
I'm just curious, with this deal that you talked about here, how was this your? You said this was a 9 or 10 unit project, I believe, is what I heard.
Yes.
And had you done that before, or was that basically your first go at it?
I actually is deep to that level.
Yeah.
First one, and probably my last one to go, because it was like, but I do have 8. In fact, my first unit I bought was 8 units. I started with multifamily, so I bought 8 units and another 8 units of my own. Some of them I would do like a lending, just somebody to lend me money for a few years where I buy them out later. I then got the 10 units, then I have a 33 units also of my own. So I have, I've done 8 units, 2 8 units before this. And actually, I think another 5 units before that one.
I see. And so
they were moderate value add.
Okay, thanks.
Bayo, I'm understanding that cash flow wasn't your motivation for that particular property.
No, it was the sale. So the goal really is, right now it's fully 100% occupied. This was bought, it was bought, I think, June 2022. And by mid-2 of last year, we finally finished it. And we occupied now, and they're probably going to exit completely by next year. Yeah, so was the main thing for that.
Any other questions? Feel free to come off mute or you can add them to the chat. In the meantime, I'm going to share another deal. So the first 2 I shared, one was the highlight and one was the low light. So 2 different ends of the spectrum. So I want to share one in the middle. Now, this is my second deal that I ever did as an LP. Also around the same time frame, I bought into it in February of 2019. Show you guys. This was the deal. So 282 unit in San Antonio again. So I was big on San Antonio in the beginning of 2019. And you can see the purchase price there. It was 18 mil. Scrolling down to the debt, it was a 10-year term, 5.505 fixed, 1-year interest only. This deal is also done by some really experienced operators as well. They weren't, say, like super experienced as in terms of going through different cycles, but they are at least, that was like their 4th deal, their 3rd or 4th deal. Okay. So in this deal, we ended up selling the deal for about 24 mil. This was in late 2021, again, when all the deals were finally starting to trade, right? Interest rates were low. There was froth in the market, so they were able to sell. So that's a 2.8-year hold. There was actually no cash flow in this deal for the entire time. Even though there was a pref, there was no cash flow. It ended up yielding, the numbers that it produced was a 20% average annual return and a 1.56 equity multiple. And so the pref was returned, even though in the deal, the actual OM, the offering memorandum, they suspected or projected 8 to 9% cash on cash return. They ended up only returning the pref, which was about 7.5. And that was what was returned in lump sum at the end of the deal when it sold, on top of any of the capital gains. So they struggled through the deal. There were multiple things. I think the biggest thing was the property manager. They didn't have a property management team that was aggressively enough carrying out the business plan. And so they were struggling with occupancy. It started at like over 90% occupancy, and then it was down to like high 70s. So they struggled with collecting rents. So they actually had to not only change property management, once, but then they eventually brought property management in-house. And this was actually the beginning of their foray into in-house property management. And they actually manage properties for other syndicators now, including their own deals. But I bring this one up because projected 8 to 9% cash on cash, that looks really attractive, right? And my particular financial freedom plan is to build up my passive income streams, meaning literally sit and collect a check. So I felt like this was a very good learning lesson. This was one of the first learning lessons that kind of showed me the cash on cash return, the pref is not necessarily guaranteed. You can have a plan to replace your income, and that's mine. I'm a physician. I wanted to replace my physician salary or match it with passive cash flows. But if deals struggle for whatever reason and you just don't get that cash on cash return at that time, I call it realize cash on cash flow, then that impacts your strategy. That made me go back and think, like, all right, I have to look at stuff that maybe has a little bit more guarantee of a cash flow, or maybe it takes a little risk off the table for a smaller cash flow, but more guaranteed to cash flow. So hitting more singles instead of doubles, or instead of swinging for the fences, because that's key in my mind. So yeah, the returns ended up being okay. 20% average annual return is a good return in my opinion. And the cash flow essentially was caught up in the end. So it turned out to be okay. They turned things around, but you can also say, hey, you bought it in 2019. Did the market actually do most of that work? Or was it a combination? I like to think it's a combination. I've invested with these guys again and actually helped raise for them. Eventually came back around to doing a lot of work with them. And now we're cash flowing in a current deal that's about a year old, and it's cash flowing at 6.5%. And it cash flowed from the 6-month mark of the investment. So it seems like they've learned their lessons. They've continued to improve their systems, their processes. And yeah, I just want to bring that one up, not only for the takeaway of this financial freedom plan. It's not all cash flow is guaranteed. And in fact, a lot of deals, they will say 9%, but that doesn't mean you're going to get it up front. Usually it comes on the back end. Up front, it might average 4% for the first year, and then maybe 7% year 2, and then 10% year 3, and 11, 12%. And then it averages out over the time frame. I didn't respect that when I first started investing. I thought it was going to be 9% year 1. You know what I mean? And so I think that's a really good take-home point when you're considering these pro formas. What else do I have to say about it? Yeah. So any questions about that deal? So can we say that high cash on cash return could be a red flag? I would say yes. I would say what you want to do is get familiar with the different asset classes and understand what conservative cash on cash return is versus what is aggressive cash on cash return. I think for value add multifamily deal like this, by the way, this was like a 1970s property, so it was definitely a value add play. I think the reasonable return rate is between 6 and 10%. And I think that changes over time too. Like in the beginning of the cycle, it's double digit cash on cash return. But towards late in the cycle where we were in 2019, you're probably more between 6 and 8% cash on cash return. And it even got to the point in 2020s, 2021, where I was seeing 5% cash on cash return in the projections, because that's just how expensive the deals were getting. They're getting to the point where you couldn't as assuredly deliver a higher cash on cash return. And the goal is always to underpromise and overdeliver, but have to have respect for the macroeconomics and where you are in the market cycle and your expectations. Whereas like maybe an oil and gas deal, now you're expecting high teens and into the 20s cash on cash return, because that's the type of risk that is involved in that deal. You're looking and searching and drilling for oil. There's a high risk that you may not get anything back. So the cash on cash has to reflect that. But if you hear someone saying 70%, 80% cash on cash return for oil and gas deal, by your experience, this is a little too far out of the range, right? That's not what you would expect, right? And Bio can talk about kind of oil and gas deals and some crazy cash on cash IRRs that we've come across. So I'll stop.
That's a whole other issue, because oil and gas also, the return is dependent on the price of oil. So when the oil is high, everybody was getting 19%, 20%, and then the price goes down and you're down to 4%. So it's just, there's risk inherent to all these asset classes. It's just to diversify as much as possible and also know exactly what you're looking for. And like George said, there are some deals when we've looked at multiple deals, we actually slow down our deal making. We see deals come across our desk all the time and we'll analyze it. There will be like a new construction that's just finished construction, low risk of things happening, right? You have a builder warranty of a year. But when you analyze that deal, it's probably going to give you 5% or 6% cash on cash. So if you really, and it's occupied now. So if you really want to take less risk, you probably would go for that. But the IRR is probably going to be like 14%. But then you're more likely to get that cash for sure on that one. Whereas you can go for a value add, which is going to be 2x. I believe that value add overall should always 2x. At least if you don't get close to 2x, then the risk is too much for the return, right? Usually, I look at your deal, George. So because it was 18 million and the value add was like what? I think it was like $1 million or less.
Yeah.
So that's light value add. So, actually inherently is actually very low risk.
Yep.
On paper, obviously.
$925K rehab budget.
Yeah. So that's very light paint and a little bit of even, I don't even think I can do much flaws with that. Yeah. So for example, also, there are some things like car wash, right? We've seen car washes up to 18%, 15%, but most of them will get you 12%, at least on pro forma, right? So, but when you exit most of these deals, you don't get you don't have a lot of equity at the end. So you have to decide what is your goal. So if your goal is cash flow, just replace your income, then you probably should go for some of those too. Some of the other those deals that just have or lending, or go out and lend out money for 12%. But if you just want to do real estate syndication to replace your income, I think in this climate, it's going to be difficult. That's just facts. However, if you're trying to just build equity and double your money faster, so that's a different strategy, then those are great options.
Another question from Charles. So are you looking for more investors, accredited, sophisticated? Do you fund 506B or C? In general, what's the initial amount you ask for in an investment, 50 or 100K? Are investors coming on as GPs, LPs? Are you doing debt or equity? I'm sure it's as per deal, each deal, because every deal is different. So yes, always looking for investors. We're looking to help as many people get financial freedom and build wealth as possible. We've done both 506Bs and 506Cs. Usually in our community, we'll have folks who will be accredited just because of maybe higher income, but definitely doing both. In general, the initial amount on average is between 50 and 75K, but then there's always discussions that can be had for lower price of entry. That's also the strength of pooling capital, because you can pool capital with one, say, syndicator and bring a big check in one to a deal, like $5 million check. But that barrier to entry into the $5 million fund of funds is a little lower. So maybe you can get access that you wouldn't normally have. So we consider that as well. Are investors coming on as GP and LP? Yes, both. There are folks who want to be more involved, who want to bring some of their skills to the sponsor team. That's always opportunity, especially if we already know you guys in the community. And we have a webinar that we talked about all the different roles of the GP team. So if you have a skill in underwriting, skill in marketing, investor relations, finding deals, you just have a good network, that's all valuable. Right now it's just equity, but I'm definitely considering the debt side. And I think Bio is considering it too. But I would love to play on the debt side as well, whether that's preferred equity, mezzanine debt, or even get to the point where you can be the senior lender Ultimately, the goal is to be the bank.
Yeah. The risk is much less because if something happens, just take you take the property, and then if you're an operator already, then you can operate it.
Correct.
So I'm going to say this addition, and then I'll answer the rest. Yeah, in terms of the debt side, our thought is the fact that there's a lot of operators struggling around, right? If you're an operator, more operators, and I can tell you, there's a lot of things brewing under the table, right? That I'm not sure. The fact that they might cut the interest rate this year might save many deals, so that they will be able to refinance or find a way to basically survive 2024. So basically, if most operators can survive 2024, most of them are going to be all right. So the question is, can they? So that's where we are. And we do believe that some will fail. And that's why many people, if you notice, many groups are doing debt fund now, raising funds just for debt, because they're preparing for that. And we thought about it. We thought about joining some, because you want that to be ready, because you can lend it out at a higher rate, right, to save people. So let's say a deal is about to fail like in October, and they need to just survive, a little bit more, 6 months, and you can lend them for 15%, 20%. It's an opportunistic kind of thing, but hey, this is just capitalism. So that's why we're looking at debt funds. And you can also lend privately if you want to. I do some personal lending once in a while for people that do like flips. And those are very quick. Sometimes you will get sometimes for 3 months, you can get like 15% or 10%. They're very quick. Of course, you run the risk of, if they can't do that flip, you lose your money. Or you can be second. The one negative thing about that is that usually you're second lien. So the bank comes first and then you come second. So only if there's more money left, if the bank take over or if the bank sells it, that you can get your money back. So the ultimate goal is for you to be first position. That is life goal. You have to have a lot of money raised. If you raise enough, let's say you raise $50 million, you absolutely can.
Yep.
You can be the bank.
So, Bayo, I have a question for you. At what point in time do you contact your lender? Say you're underwriting a property. At what point in time do you contact them to know what rate or what debt product that they can offer you for that particular building?
Yeah, immediately we have a basic underwriting. We send it out. You send it to local lenders, and we have a kind of broker. So that's the best. If you want information, just text me, remind me. I'll forward you the information of some of them. So you basically send it to the broker. The broker will go around and shop a bunch of loans for you. They will shop, especially the Fannie Mae and Freddie Mac loans. Those will have a lower rate, but they also have a more requirements, right? Lower rate, but a higher requirement to qualify for. We've seen as low as 6% nowadays on those. Whereas you have banks, some banks will do 7% now, but most banks are still doing 8.5. So you have to decide so you have all of that. So it's going to come back with, we have these three options. And then you also have some few bankers that you talk to locally. And then you talk to your team and decide, because sometimes you can go with the local bank because they would agree to some things that other lower rates banks will not agree to. So you just have to decide. But yeah, a broker is what I found out to be the most efficient, rather than talking to individual ones yourself. They don't charge you. They charge probably the bank, but there should maybe a point sometimes, and it's well worth it in my opinion. Saves time.
I think that answered the next question, which is what lending banks do you suggest? Local relationships, very key. A lot depends on the size of the deal too, like how big the bank is, but local bankers is a key to have. But keep in mind the macro, make sure that you understand what the banks, if they're at risk, because there's a lot of banks that lend out to commercial like office spaces right now. In fact, the majority of office real estate is serviced by community banks. So they may be at risk coming into this next year and the year after. So understand the financial health of the bank too, but local banks, local lenders.
Yeah, and the same way, the local lender might also be better. Then depend, because sometimes you might know there's a president of a bank where we grab drinks together. So I know some information. Let's just say that they lend to farms, they diversify, and I like using their products. Even it might be more expensive, but I know the kind of product that they lend on makes it a little bit less risky versus, like you said, office space is having issues right now.
And if you get into trouble, if you have a relationship with that bank, you can work things out. A lot of workouts are happening right now. As I'm on these calls that these deals are struggling, they're actually communicating very frequently with the banks, figuring out ways to either extend the loan or even redo the loan or drop their interest rate. There's a lot of different things you can gain just from having good local relationships.
And
Have you
that's
guys,
true. Yeah.
have you guys ever had like non-recourse loan from a bank?
Actually, I've had offers for non-recourse loan from banks, local banks, but usually the rate will be too high for me to do it. So it will be like, you know what, I'll throw you a 7.5 for if you're going to guarantee it. I know you have all these assets and you're a doctor, and I know where your office is. I can find you myself if something happens. So we'll talk like that, and then you'll be like, but if you want non-recourse, then that's going to be 9%. So then you have to go on that with your underwriting, and then you're going to be like, your cash on cash now goes from 8% to cent. You're like, ah. So you go back, you know what? I'm going to guarantee it. And then you have key principle. And if you really believe in the deal, many operators will guarantee the loan, especially if it's local. For me, it also let you have skin in the game. However, if the deal is too big, obviously that would be difficult, right? If it's like a $50 million deal, your net worth has to be close to that, to the cost of the property, or at least the down payment, the LTV. If you're borrowing 40 million, your net worth has to be 40 million. So that's where you find your uncle or some or another investors that has a higher net worth, and you bring them in if needed, or just go non-recourse with higher rate or agency debt. But like George is saying, agency debt, it could be risky because they usually agency, once your occupancy drop below a certain level, like we have deals that would temporarily drop below 90%, and it will send you a letter like immediately and said, well, basically that they're basically like you're at risk of losing this loan and us taking over.
Hey, by what's agency debt? I'm sorry. What specifically?
Oh. So these are just like, I guess it's a private debt structure. The most common is like the Fannie Mae. So they usually give a lower rate, but usually they have a very strict requirement, like you have to have 90% occupancy at all time, not more than 3 months of lower occupancy than that. So they will have so many lists. And another lender, like a private family offices, is another one that I've seen that is harder than agency in terms of their requirement. There are family offices that will lend you, be the bank, but they're usually very quick to want to take over the deal or take it from you. So they will have so many strict requirements, but the rate might be lower because they're family offices. They can do whatever they want. They can be like, I'll borrow you for 5%. They can do whatever. Yeah, so just have all these different type of lending options.
And another thing about those agencies is they're tied to the federal government. I think they call them GBEs or GSEs, like government-backed entities. So they're secured almost by the US government. And that's different than like these private lenders, right? And I think that's how they're able to maybe give lower rates. They end up taking on a lot of the activity that goes on with lending for these type of commercial properties. There was another question about mezzanine debt. So here's this capital stack chart. Mezzanine debt is like a private lender. It's just a second loan. If there was not enough from the senior loan to cover the debt, then you can have like a second position of this. Could be private lender. I'm not sure if there's any other entities that lend into that. But then there's the pref equity above that, which functions like fixed income, but they're underneath these two levels. They usually don't have a lot of equity, even though it's called preferred equity. They're usually just getting a fixed return, and therefore their upside is not as big as the common equity. Common equity is the last, and they usually have the biggest upside because they get paid in the end, but everyone gets paid before them. But they not only get cash flow, but they get the equity, the capital gains as well. And tax, they get tax breaks. I don't think pref equity or any of these, I know for sure the debt doesn't get any tax breaks. That's treated as income. And pref equity, I don't believe gets any tax breaks as well.
I think there's a few more questions. Let me see if we have time. With your deals, are you getting with the city to acquire the funds they have, grants? We haven't in our deals, but it doesn't mean you cannot look for that. If you're trying to do HUDs, you can, or like underserved area, there are grants and things you can get into. There's also a nonprofit piece that can help with grants. I agree, but everybody's strategy is different from what you're doing. Many of these grants and deals, they want you to stay there for a certain amount of time. But if I'm trying to exit my deal in 3 to 5 years, I want more freedom about the deals. Have you dove into opportunity zone? Yes, we had a self-storage with the sole purpose is to take advantage of that opportunity zone. There are some rules with opportunity zone, like you have to hold it for a certain amount of time. I think one of them is like 10 years or so. So to get all the full benefit. Something you have to think about, are you trying to hold these? What if you want to sell in 3 years? So that's just something to think about before you go into these deals. What is your thought about investing in private credits? Judge, what do you think?
I don't think I know what that is. If you don't mind, unless you know Bio, if you don't mind.
No, that's why I'm wondering too, what private credit?
You can come off mute and further clarify if you want. What about, until we hear from, the next question is, does that include first trust deeds? And I think this was in reference to something before. Sonia, could you tell us what you were referring to? Because I don't know what first trust deeds are either.
That's when you're acting as the bank. Those are first position as the bank. So first trust deeds is the first position. You are the bank. You're loaning to a seller, a buyer directly. And they have a third party that's actually servicing the loan.
Gotcha. Yep.
We done a couple of those, and that's why I thought that's what you meant you were talking about doing as well too.
Yeah, eventually. Yeah. I definitely hope to get to that point. So
that's the safest position to be, right?
So, fixed income, it is lower returns, but
some of them are pretty. Some of them we're getting anywhere between 10 to 12%, and you say it's safe just in California. We backed off because this is a state where, especially if it's secured by the property that the person is living in, it's harder to, if it does go under, to get them out. So they got the tenant rules here. So if you do it in another state, it may be different, but it's been good for us so far. But now we see the writing on the wall where the tenants can say, what, I'm going to hang here and until they kick me out. But so far it's been paying pretty well.
It's awesome.
Yeah, definitely would like to know more of what can be done, because we want to solve this cash flow issue, right? I do believe that we're getting towards the end of the tough times, right? Where everybody will be frothy again, and then we'll go back to another recession. But to have an idea of how to increase cash flow on other deals, while some of these cash flow turned equity deals turn around.
I can send you a couple of them just to give you an idea. I got your email address. I'll send you a couple to give you an idea.
Okay, thank you.
That'll be awesome. Thank you.
Okay. I think
I have a question about preferred debt real quick, preferred equity. So just investing in preferred equity obviously doesn't necessarily guarantee that the asset won't go under, right? Let's say it's still mismanaged or something. I guess my question is, if you invest in preferred equity and the owner or the operator still winds up having to sell it anyway at a loss because for whatever reason, does that, I guess what I'm trying to ask is preferred equity guaranteed? And just using that word guaranteed, I think is answered the question for me because I don't think anything is ever guaranteed. But
even the senior loan is not guaranteed, but they're collateralized. So they can at least take back the collateral. And different deals are structured differently, but some of these pref equity groups are now doing something called a cure clause. They're working out an agreement between the original operator and the lender that gives them the ability to take over the property. And that can look many different ways too. But essentially, they can take over that property if the original operator either defaults on the senior lender or the pref equity piece. So that's a little bit of a mitigation strategy. But like you said, there is nothing that's 100%. If you have a pref equity group that's not ready to operate the deal, yeah, then they won't have that cure clause worked out with the lender ahead of time. Pref equity groups are working that into the deal ahead of time before deploying their capital or committing to a deal. Yeah, it can get bad enough where the value of the property drops so low that it's going to go back to there's no money. That capital stack, it gets the common equities wiped out, pref equities wiped out, mezzanine debt's wiped out, and even the senior lender's not going to get their money back. They can get the property and then probably sell it at a very low discount to a very opportunistic investor. And that's what happened in 2008. A lot of banks got the property back because everybody else got wiped out. It was such a huge devaluation that there was no money to distribute to anyone on the capital stack. And so that's a great opportunity for a fresh investor to come in and buy for pennies on the dollar.
Yeah. Also, the pref equity, if you're going to do pref equity, I think, George, you remember, I think we were doing one with our mentorship program the other day, and we found pref equity that was below the common equity. I don't know if it's Vikings. I forgot which.
They were behind the common equity?
Yeah, it was so lower, but they gave a higher return. Basically, you have to just look at the capital stack also to see how far you are as a pref equity. Basically the best position I want to be is at least behind the senior debt. That's it. If I'm a pref equity guy, I'm not trying to. And also, there's this thing about pref equity nowadays that they will say, okay, you get 12% return, but you get 7 now.
Yeah, the real 5 goes back to the real. Yeah.
For me, I'm like, why am I not just a LP then?
That's a great point. Yeah, a lot of them are breaking it up into a current or realized piece, and then the other half comes on sell. So it's like an accrued piece. So 7 upfront, yearly, annualized, and then 5 on the back end. But they'll tell you on the OM, this is a 12% cash on cash. Fixed return ahead of the common equity, but you're really getting 7 for that year. And then in year 3, you'll get the extra 5 when they sell, or when you get bought out.
Yeah, but if they don't sell well, you actually lose that 5.
You lose the 5. You get 2 or 1,
So yeah, so when you want to do pref equity, I'd rather just get my 12. Thank you very much.
Up front, yep.
Yeah. So someone is asking, we just answered these 2 and we're done. So yeah, we already answered extra questions. And how do you look for deals? We have a acquisition manager in-house who is the #1 commercial broker in our town. He, he find deals. He at least make sure that maybe one in probably maybe 1 in 10 gets to me, because then he will already screen it out and already underwrite it and then send it to me. And then I would yes or no, or at least we can ask for more information, or, so that now. But before, of course, I have a lot of commercial brokers. You can make relationship, right, with commercial brokers, and then you can get a lot of deals, and then you can start underwriting them. You need to have a quick rule-in, rule-out criteria so that you don't just underwrite hundreds of deals till 2 a.m. in the morning every day for 1 year before you find a good deal. So that's what it is. Yeah, so off market is the best way to get deals, by making relationship with commercial brokers. If you have a commercial broker as one of your team member, even better. At least for that one, you know that their interest is aligned. So when they bring the deal, you at least know that the deal is reasonable. But for other brokers, especially in the beginning, I got the bottom of the barrel. And it's very annoying. So you see deals that they've shown to different operators, and they all said no. And then they send it to you. And then you are not even close to the number, So if I find a commercial broker that does that few times, I just block them completely, right? They send you deals like $5 million, and when you underwrite, it's like 2.5. You're like, we're not even close. Like, why? What are you doing? Anyway, so off market, commercial brokers. And what's the next deal that's on the table? We're constantly underwriting deals. We're constantly talking to best-in-class operators. But George is saying it's sometimes better to put your pencil down in this market if something's not working out. So we still have about 2 LOIs right now that are out. But of course, it will be like 3.5, and we sent for 2.5. So oftentimes we know most likely going to be rejected, or at least renegotiated. So yeah, it's a long way for me to say nothing concrete at this time.
Something will come up these next few years. There's going to be a lot of opportunity.
And you don't have to always invest. That's what I also noticed. I get a lot of investors message me, email me, like, hey, I said, look, sometimes just put your money in CD, just relax. It's okay for 6 months, for a year. It's okay not to be, although we always say you should need to be invested all the time, but put it somewhere where at least match inflation. And when there's a deal that comes out that you like, then you can pull it out and invest in it.
All right.
That's my advice for this time.
Agreed. Yeah. Oh, that was great. Good hour and 11 minutes.
Good. Right. And the next one is 2 weeks, right?
Yes, we're going to have another one in 2 weeks. It's going to be Bio and myself, unless we get another speaker again. And then we have one immediately a week after that. We're going to have some back-to-back, and then we'll go back to our bi-weekly schedule again. So we'll have another topic. We like chatting and sharing our experience. We do it on our coaching program too. It's good engagement. We love the questions as well. So really,
yeah, I just love this a lot. I didn't know there's going to be a lot of questions. I love it.
Great questions.
Yeah, great questions. Okay, thank you, everyone.
Thank you.
Have a good night.